super contributions, making voluntary contributions at the end of the year. What does that look like?
Yeah, super contribution is a great way of optimizing things. So currently in Australia, you can contribute up to $30,000 of pre-tax to your superannuation fund. And the idea of doing that is that if you are transitioning toward retirement, let's say you're in a position where your mortgage is paid off and you've got money that you're saving, getting it pushed across into your super effectively can be a more tax effective way. I always say to people, like, contributing more to your super is actually the third step. Number one is getting control of it. Two is making better quality asset choices. And then number three is bulking up your contribution. If you've got a super that's not performing, there's not a lot of incentive to put more money into it. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at getting on the front foot ready for tax time. June 30 in Australia is looming up as the end of the tax year, and being ready for this on every metric, whether that's your record keeping, the advice that you've got, the game plan you intend to play, and how to take advantage of maybe some of the things that haven't gone so well for you this year will all be explored in detail. As always, don't take notes, make sure you take action. We'll see you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
AB, good to be here. Now, we're going to make what is a fairly normally boring topic quite fun today, because all about saving money and ultimately building wealth, and that is tax tips to start making now for 2025, the smart moves to make in advance.
Very important thing to be prepared for. Tax is one of the certainties in life, rather like death. You got to pay it. And I guess the key thing as a preface for everything we're going to say, get proper advice. Don't try and cut corners. Don't think you're smarter than the ATO where you can, I can hide this or claim that. Play a straight bat to it, but play right to the line. Work out what you're allowed to claim and claim it.
That's right. And look, by no means are we giving advice here. No. We're rather just talking about personal experiences that maybe you and I have both had. And I guess this episode is not necessarily tailored at business owners or entrepreneurs, because the tips and tricks will cover it pertains to whatever your employment status is. Very
much so. I mean, again, the further up the food chain you move in terms of structuring, then that does open more ability for you, I suppose. But if you're a standard pay-as-you-go employee, there are still things that you can be doing to enhance your tax position so that you're getting the best opportunity or outcome that you possibly can. And we've got a government that seems to love spending our money pretty well, so not wasting too much by giving more than you have to them is a good policy.
That's right. And paying a good amount of tax is not a bad thing. It means you're earning a good amount, right? It's just about paying the most amount of effective tax that you can, right?
I like that. Pay the most amount of effective tax. I like that.
That's right. All right. Now, let's start off. A big one on most people's mind. I've had a few questions on this actually from other listeners on the podcast. Capital gains and capital losses. Can you offset them, and how does that work?
Yeah, look, capital losses, you certainly can. One of the strategies back in the day, pre-June 30, is if you've got some loss-making positions on the book, and look, we've had a fairly difficult time in markets, through the early part of the 2025, so some people may be sitting in losses on some of those. Creating that loss this tax year, so you get the deduction on it, and actually realizing the loss by closing the position gives you the ability to claim the tax deduction this year. You can always rebuy into the position on July 1st, and then as it improves, of course, you're going to have to pay the tax on the profit you make on that, but you can certainly get the loss this year. And that might be something that's worth looking at. It's called bed and breakfasting, out this year and in next year.
The bed and breakfast strategy. Yeah. So correct me if I'm wrong. So the capital loss, that offsets some of your taxable income or offsets capital gains?
Yeah, you can use it to offset your income effectively.
Okay, right. Okay. And then capital gains. So if you've got some gains on the book, whether it be selling property or shares, those losses can offset that, right?
They can go to some way to extend to offset that. Again, getting structuring advice from your accountant is absolutely crucial on this, because if you have yourself set up, for example, as a trader, you'll be taxed as income, not capital gains.
Interesting. So it's at your marginal rate then in that case, right?
To be at your marginal rate, which is likely to be more attractive than the current CGT rate, which is effectively 50% for a lot of people. So making sure you've got your structuring in play to avoid that nasty CGT expense is absolutely crucial.
Interesting. All right. Now, any other, I guess, broader tips around capital gains or losses that you'd suggest, AB, or maybe anything you've done in the past yourself?
Look, it's good to have a full assessment of your portfolio, which you should be doing on a reasonably regular basis anyway. And over the many, many years, particularly in the early days as I was working, as a broker, I suppose, is, when you do that portfolio review with clients and let's say they've got some absolute howlers in there, every cloud does have a silver lining and saying, look, you've got this defunct mining stock that's trading at 2 cents. what are your plans for this? Oh, one day it might come good, or do you want to just slice it out, take the loss this year, and really utilizing those sort of crevices and corners in a portfolio to optimize the tax situation? It's a crucial thing to do. And so every cloud does have a silver lining. If you're holding stuff that's not done well, then get the benefit from it this year. And the flip side of that, of course, you might argue that, but then I've got to pay more tax down the line. A bird in the hand is worth two in the bush.
That's right.
It's as simple as that. And I'd rather have the money now and get it working than down the line.
Actionable steps then for our listeners, I might add, if you've got capital gains or losses for that matter, talk to whoever you need to. As you say, accountant, but obvious one, talk to your broker if there's something you can sell or buy. And also, whether it be a property agent or something like that, could be in the property space as well, right?
Also, like when you're disposing of stock, you've got last in, first out rules. So you want to be very, very clear on your instructions, because you might have several batches of the same stock that you've added to over time. And the tax implications of selling those different batches can actually bite you. So get advice on this. It's worth having a proper conversation. What I mean by first in, first out is if you've owned a stock for a really long time versus the most recent addition to it. If you sell something that you've owned within a year and you're not structured properly, you're going to get slugged with a reasonable capital gains tax bill. But if you've owned it for longer, it's going to be discounted. So they're just simple things within the tax laws of Australia, which are far from simple, that are worth looking at. And I can't stress again, get advice on this. We can certainly introduce you to great accountants that are able to provide absolute first class advice on this, and it pays for itself in spades. A lot of people, I've got to pay the accountant's bill. It's the best investment you ever make.
100%.
Provided you have a good accountant.
That's right. Now, second one on here, this is arguably a fairly straightforward and easy one, you might think, and that's super contributions, making voluntary contributions at the end of the year. What does that look like? Super
contributions is a great way of optimizing things. So currently in Australia, you can contribute up to $30,000 of pre-tax to your superannuation fund. And the idea of doing that is that if you are transitioning toward retirement, let's say you're in a position where your mortgage is paid off and you've got money that you're saving, getting it pushed across into your super effectively can be a more tax effective way. I always say to people, like, contributing more to your super is actually the third step. Number one is getting control of it. Two is making better quality asset choices. And then number three is bulking up your contribution. If you've got a super that's not performing, there's not a lot of incentive to put more money into it. So, but up to 30 is what you can put in. There are also rules called bring forward, where you're allowed to bring forward future superannuation contributions in a very tax effective way as well, which I think currently is, I'm not an accountant, so the numbers I don't necessarily think are going to be exactly right, but I think you can bring forward about 330 grand or thereabouts as a bring forward contribution on a tax-free basis. Get advice on that. Get advice on that. But that's, again, if you've got a situation where, for example, you've had a big chunk of cash flow that's come into your business, you can put it through into your super potentially, and that might be worth looking at, especially if you've, say, got a pending property transaction or something in your superannuation fund and you want that extra fat in there to be able to accommodate that.
So, devil's advocate question for you. Let's say you're young, relatively like me. Why contribute to super early, above and beyond that you have to, when you can utilize those funds in your normal adult life?
It's a great question, and it's the $1 million question. The key thing is, if you can utilize those funds, everyone can utilize their money. It's a question of whether they're utilizing it in a good way. If you're in a situation whereby you're able to buy other real assets, and let's say you're looking at another property purchase, and you've got a choice of, do I put more money into my super now to fatten the goose for down the line, or do I get my mortgage paid down, or do I put it in my offset account, very tax effective, of course, or am I buying another investment property? Ultimately, you've got to look at what the long-term growth looks like on those decisions. And if you're doing a property, if it's in your own name, it's capital gains tax free. So it's ultimately one of the few tax-free spaces that you can work with in Australia. So that ability to wrap it back up into your primary place of residence and grow your wealth that way. Maybe you're buying a house that you're going to renovate and add some value to it, and you might make $300,000, $400,000, $500,000 on that over the next 2 or 3 years by doing a good renovation in your primary place of residence. Well, that's going to be probably a better outcome than squirreling it away in super, where the average super last year grew at 11%.
That's right. And I've undertaken that exact philosophy, full disclosure. So my philosophy was the rate of return I can earn on those funds is greater than that of what I'd save by applying extra contributions to my super. So that's been my exact strategy.
There will become a tipping point in there, but at your age, that's a great pathway to take because you're at the accumulation stage in terms of what you're able to do. And I think that's probably a smart path you're on. You must have had some good advice.
Good accountants, right?
Good accountants.
Now, what about franking credits and dividends to move forward here? Is there anything you can do around timing of those? I mean, what are franking credits for a start for our listeners, and how does that all work?
So Australia, one of the many unique things we have in our blessed country is something called a franking credit on dividends. So when a company pays you a dividend as a shareholder, effectively it's your slither of the profit that that company's made over the course of the year, and it's your reward for owning those shares. A franking credit effectively is where the company has prepaid the income tax on that dividend for you. Now, if you think about that for a minute, the prevailing corporate tax rate as we speak is 25%. And so the tax is paid on that dividend. So let's say you received $1,000 worth of dividend. Ordinarily, if that was being paid to you in your own name, and let's say you were on a tax rate of 30%, you're going to be paying $300 in income tax on that dividend. But because it's what's called fully franked, where the company has paid the tax for you, they've already paid the tax at the corporate tax rate of 25%. That's already paid. So what you receive, you've then only got a further 5% of tax to pay to top that up to your marginal rate, so to speak.
So the surprise is less bad almost.
Yeah, so your income is effectively more true income to you rather than it's gross and needing netted off. Now, if that's something you're operating in your own name, obviously any tax saving is great. Where it really becomes of a significant benefit is within superannuation, where the tax rate currently is 15%. So if a company has paid a tax on your dividend at 25 and the actual tax rate in your super is 15, what's effectively happened is there's an overpayment of tax on your behalf, and you can use that credit, that franking credit, into other tax liabilities that you might have within your fund. So it's a big thing for self-managed super in particular, to attract high level of dividends that are fully franked, because it is a very, very tax effective strategy to run in your super.
So question for you, let's say, so super tax rate 15%, tax rate paid on the dividend 25%, there's a 10% marginal benefit to yourself there. Correct. Is that all happen automatically, or does that need an accountant to go and work that out and get you the savings?
When it comes to getting savings from the ATO, and excuse my cynicism, you got to ask for them.
Okay, so it doesn't just happen on its own.
No, nothing. Very rarely do you get anything that's paid back to you on a voluntary basis. And what you can effectively then do, of course, and this is where it becomes a little bit more of a sophisticated question, is that franking credit that you've received, you can use to offset other areas of tax liability that you may have that reduces the overall tax bill within your super. So, if you're a higher income earner and you're on a Division 293 contributions tax, which is not fun, and it's one of the things you have to absorb if you earn more money, you can use that franking credit to then start to chip away at some of that additional tax that you've got to pay under your Div 293.
Interesting. There you go.
That is a very complex area, which I'm going to not dive into in too much detail.
Quality problem to have. You earn too much money, right?
Well, not necessarily in Australia, because it's not fair that you earn money. Therefore, we're going to tax the hell out of you. Excuse my cynicism, but I've just literally had two bills, one for my wife and one for myself. That are those, and it's just like you're trying to contribute into your super to provide for your welfare in retirement and be less of a burden on the state, but only after they've taken their oversized bite from it.
That's right. Interesting. Okay.
Yes, and I'll move on now. I feel cathartic for getting that off my chest.
Yeah, parking that to the side, right? Let's go to something different. What about record keeping? First one off the bat that springs to my mind, if you've got a corporate structure, keeping a logbook on your car, if you've got a corporate vehicle, that can save you a lot of tax. Anything else that you'd suggest?
Look, there are a myriad of things. When it comes to this, and I go back to the preface for the conversation, is find out legally what you're entitled to claim in the various entities that you have. And this, for example, what can you claim for your kids when they're at a working age, and all of the different things in there. Find out what all these things are and utilize them, because that is the playbook that we've been given, and our job is to play to that line. So let's start off with your motor vehicle. So the ability, if you've got a work car or a car that you use for work, is keeping a logbook to show what proportion of travel is work related. And there's some obvious things you can't claim, like driving to work, for example. That is not something you can claim. But if you're going from the office to a client meeting or an event of some description, then that does become something that's claimable. Some of the other areas that are a bit more challenging, if you're in the space of work from home and you're starting to claim things from work from home. So you might be able to claim your electricity or even some level of space off your rent. If you're working from your primary place of residence that you own, then there are tax implications for making a claim.
Yeah, you don't want to do that,
from there, because then you might find that your property sale, which should be tax-free, is no longer tax-free because you've been claiming a deduction. Again, these are all important conversations to have with your accountant rather than finding out on
so that's a tricky one, isn't it? Do you get the tax advantage now by making the claim working from home, but potentially pay capital gains tax later on when you shouldn't have?
I think if you rent, it's a no-brainer, and if you own, then you need to get really good advice.
Yeah.
It's as simple as that.
That's right.
Because you could be creating yourself problems for down the line, which is never a good thing. And if you think about your property value potentially going up over that period of time, then the slice that's then taken becomes bigger too. So
that's right.
A little bit careful of that. So, then you've got things like work use materials. So if you're self-employed or, getting a laptop bag, you're allowed to buy a laptop bag every year. You can get yourself a new computer if it's primarily for work purposes. All of these different things, your accountant will guide you through this, and take advantage of what you can.
The briefcase rule, fully taxed exempt briefcase every year.
There you go.
I happen to want to upgrade my briefcase every year for some reason too.
I don't know that the ATO put a ceiling on how much that briefcase can cost.
I think it's unlimited, isn't it, right?
That's a question for your accountant. I'm not going to get pulled into answering that.
All right.
I believe that, there are things like that you can do. So, but they're messing around at the margins. On the core thing is to make sure that your pure deductions are done in the right way. Again, if you've got life insurance, making sure that life insurance is parked in the right entity where it becomes a deductible expense rather than one that you're wearing personally. Income protection, TPD, all of those different things, and making sure that they're slotted in where they need to go to give you the optimal benefit is crucial. And again, if you think about the world that we live in, everyone, before they spend any money, is at a price and value decision. This is what it's going to cost me. What am I going to get for what I'm spending? And looking at professional services, and I don't blame people for having this view. If you look at the Royal Commission, it showed that the advisory space has been pretty corrupt and not acting in the best interest. Not all advisors are like that. Find a good advisor, and we've talked previously in other podcast series. How do you find a good accountant? How do you find a good advisor? What are the steps to go through to make sure they're acting in your best interest? Relationship fatigue, all the different things that we've spoken of significantly previously. Then you've got to weigh up and say, okay, they're going to charge me this, but if the value add that they bring to the table is that, it's worth it in spades and some. And I've had an accountant that's charged like a wounded bull. I've had legal advice which is eye-poppingly expensive, and it's been worth every cent. If I 10x'd what they charge me, it would have still been worth every cent.
Oh, yeah.
And so you've got to get past price is what you pay, but value isn't always what you get. You get a good advisor, the value add is infinitely more than what you pay. Sometimes you pay a lot and you get nothing in return. So you've got to weigh that up yourself. But sitting down and working out what you can do with this and how you can optimize the hard work you're doing is crucial. You have to do it. And, there's a swag of other stuff. If you're a tradie and you've got a guard dog in your yard, that dog could be a tax deduction for you potentially. Wow. If you got a little chihuahua that sleeps at the end of your bed, that probably isn't going to be something that you can deduct as a guard dog. You've got to apply some common sense to this kind of thing.
My parents have got small dogs. They seem to be the most feisty.
They are, but
the big dogs are scared a little bit.
I think it's a long bow to draw when you sort of go, here's my machinery yard. I got $500,000 worth of equipment. I've got scaffolding or a concrete mixer or concrete cutter. And here's the Doberman or the Rottweiler that I've got on the chain guarding it versus little Fluffy that's sleeping.
Yeah, I get it.
Doesn't pass the pub test, does it? And it certainly won't pass the ATO scrutiny.
That's right.
But there's an example of sort of looking laterally to an extent. And again, I can't stress how important it is. Don't step over the line, think you're being smart. I can save an extra few bucks if I do that. Systems are so sophisticated now for matching earnings and expenses. You're just creating a hole for yourself. And look, to that end, if you find yourself in a situation and you're consuming this where you do have an ATO problem, where perhaps some of the deductions you've put through have been knocked back, or you're subject to an audit and you're on the ropes and you feel like you're getting smashed, which you probably will be under those circumstances, feel free to reach out to us. We have a panel of expert advisors that we use. I have, in my opinion, arguably the best tax lawyer in Australia that we can refer you to if you need help, if you've really got yourself in a bind. And it's good to have that third party delivering value and quality advice to protect you from what could be a fairly unpleasant experience.
Absolutely. And I'll offer a piece of advice here to our listeners. I'm not a tax expert, but one thing I'm good at is organization. So I think the message is clear. With all of this, you've got to know your stuff in advance and be clinical about it. Organize your receipts, have your files in order, know exactly where you're at, because when it becomes a whole mess of receipts and expenses, it makes things really hard. Give your accountant all of the information really easily, and then they'll give you the benefit back.
Too right. Being organised, for a start, if you're organised, your bill's going to be a lot lower with your accountant than if you go in there with a banana box full of stuff that's got coffee stains and God knows what else all over it. And you go, here you go, here's my tax, work it out. They're going to charge you heftily.
So they should.
And they should. Someone's got to enter the data. So getting good record keeping data, whether it's Mile, I use Xero for all of our stuff. It can link to your bank account, your credit cards. It sucks all of the information in, and you can give yourself, and not only that, it's largely real time and live, so you can see where you're at through the year anyway, and find yourself in a position where at the end of the tax year you go, right, that's the final report, this is where it's at, and hand it over. And like one of the joys that I like to impose on my accountant and our auditor for our business and our financial services license for that matter is I want to be the first set of accounts you get done for the year, and I want to be the first client that you audit for the year and get the audit lodged with ASIC every year, first in, always. That's my driver that I provide them with, and to an extent, I think they rise to that challenge insofar as everyone else is still scratching around getting ready. So literally 2nd of July, I give the accountant everything that they need in order to do that. We have our pre-audit meeting with our auditor, and most people aren't going to be in a situation where they have an auditor anyway to do what they do because they don't sort of run the sort of businesses that we do. But I have the pre-audit meeting with the auditor, usually 2nd, 3rd of July. They're going to go through some preliminary questions that they're going to have. Accountant sits in on that meeting as well to make sure everyone is on the same page. We get the action points done, and then they get the information they need
done
pronto before the big rump of other people are coming through. And invariably my accountants are audited and signed off before most people have even got to grips with their record keeping. Important job done. It's all lodged with ASIC and the regulator, which in our case it needs to be for a financial services license. It's also lodged and ready for a professional indemnity insurance review, which comes later in the year. And my insurance broker's like, everything's here, I've got it. So nothing is at the 12th hour. And if it's not at the 12th hour, you don't tend to have to pay as much because no one's rushing to do things. And personally speaking, you have the peace of mind of that unpleasant job of getting all that done is in the rearview mirror, and you get on with what you want to do, which is driving your business, making money, doing the things you enjoy rather than stressing about, oh, I've got to do my tax. And it's still fresh in your mind because it's the year that's just gone. So that's what I do. Kids help me with all the archiving of the paperwork at home. They've all got their responsibilities now. So
you have to pay them for that. So their employees.
No, they get to hang out with dad, which is great. So making the mundane fun is the key thing with kids. And so one of them will have the plastic sleeves that all the bank statements go in. One of them's looking for the credit cards. Then they get them into chronological order. Somebody else has got the bill spike. That's got all those on, and they're putting them into the monthly folders. All goes in the archive box and off to archive and storage.
Yeah,
fantastic.
Very nice.
So it's just about being organised, and I couldn't agree with you more. You have to be. And when it comes to your trading statements and things like that, back in the day when you used to get a paper contract note that some people might still get if they're under the old hin and chest systems, look, great, well done, but everything is digital these days, and being able to suck it into a reporting system digitally, our platform does that. So it's literally a CSV file that the accountant can upload and make life really easy, and you can see your deductions and everything in there. So again, that's being organised, and it's not a Herculean amount of paperwork. It's just digital, and it's done properly.
There you go. You heard it here first. Thank you very much for today, AB.
Yeah, look, absolute pleasure. Like tax time, it's a game, isn't it? You've got to do it. You got to get there and trying to make it as least painful as it can be. Both getting the process done and any ramifications afterwards are key. So play by the rules, get great advice, get on top of it early. And once it's done, it's done.
It's done. That's right. Thanks very much.
Absolute pleasure anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button. We'll look forward to hosting you next week.